Why do investors make irrational decisions due to bias? Imagine making a choice about your money based not on facts, but on feelings or habits. That's often what happens when biases influence investors. It might seem strange, but our brains are wired to take shortcuts when processing information. These shortcuts are called cognitive biases, and they can lead investors to make decisions that don't make sense in the long run. Cognitive bias is a pattern where our judgment drifts away from rational thinking. When investing, this means we might ignore important facts or overreact to news. For example, if someone is emotionally attached to a stock, they might overlook negative reports about it. Instead, they focus only on positive news that supports their belief. This can cause poor investment choices. One common bias is overconfidence. Investors often believe they know more than they actually do. They might think they can predict market moves perfectly, leading to risky trades or holding onto investments too long. This overconfidence can hurt returns over time. Confirmation bias is another problem. Investors tend to look for information that supports what they already believe. If they think a stock will go up, they ignore signs it might fall. This prevents them from seeing the full picture. Loss aversion is a powerful bias too. People fear losing money more than they enjoy gains. So they might hold on to losing investments too long, hoping they will bounce back. Or they might avoid making profitable trades because they fear losing money. Herding bias is when investors follow what others are doing. If everyone is buying a certain stock, they jump in too, even if it's not a good idea. This can inflate bubbles or cause sudden crashes. Anchoring bias is when people relying too much on initial information. For example, if a stock was once worth $50, they might think it's still worth that, even if the market has changed. They get stuck on that first number and ignore new data. All these biases influence decisions by making us emotional or biased in how we see information. Even if someone knows the basics of investing, these mental shortcuts can lead to mistakes. They might buy high and sell low, or miss good opportunities because of fear or excitement. To avoid these pitfalls, investors should become aware of their biases. They can seek advice from professionals or look at different opinions to challenge their assumptions. Setting clear goals and sticking to a plan helps prevent impulsive decisions. Regularly reviewing investments based on facts, not feelings, keeps decisions rational. Remember, biases are natural, but recognizing them helps you make smarter choices. This understanding is part of learning the basics of investing and can help you build a stronger, more resilient portfolio.